Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of corporate filings. And let me tell you this Enterprise Financial Services Corp 10. It's got some interesting chapters like deciphering ancient scrolls. Get ready for a deep dive into a company shaping the financial landscape, exploring their numbers, their risks, and what it all means for their future. And hey, if you love getting the real story behind corporate finances, join our Discord community, linked in the description down below. Alright, let's get into the nitty-gritty of Enterprise Financial Services Corp, or EFSC, and their latest annual report for the year ending the 31st of December 2025. This is their big one, their 10K, telling us the full story of their year. The company itself is a pretty straightforward financial holding company, mainly focused on providing banking and wealth management services. They operate across several states, but also have loan and deposit offices all across the United States. Their mission is clear, guiding people to a lifetime of financial success. Sounds good, right? Their strategy is all about building long-term client relationships, especially with privately held businesses and their owners. They're not afraid to dive into specialized lending niches too, like SBA loans, life insurance premium finance, and tax credit related lending. And they are using technology to stay competitive, offering all sorts of digital banking tools. Now, here is where it gets really interesting. Let's peek at their financials. Looking at their earnings for 2025, total interest income hit $888.4 million. That's up from $851.1 million in 2024. So they are making more money from their loans and investments, which is generally a good sign. Their net interest income, which is the profit they make from lending after paying for deposits, nicely increased to $626.7 million in 2025, up from $568.1 million in 2024. This growth is definitely a positive trend. Now, about those credit losses, they set aside $26.3 million in 2025 for potential loan losses. This is up from $21.5 million in 2024. While an increase in the provision for losses might sound alarming, it often means they are being cautious, especially with a growing loan portfolio. Their non-interest income, which is income from things other than interest like fees, really jumped. It went from $69.7 million in 2024 to a whopping $113.1 million in 2025. A big chunk of this jump, $32.1 million specifically, comes from anticipated insurance proceeds related to a solar tax credit recapture event. That's a unique situation, but overall, non-interest income is a vital part of their business diversification. On the flip side, their non-interest expenses increased to $429.8 million in 2025, up from $385 million in 2024. This rise is mainly due to higher deposit costs, increased staffing, and expenses tied to that branch acquisition they completed. All this moved their income before taxes to $283.7 million in 2025, a solid increase from $231.2 million in 2024. And the bottom line, their net income for 2025 was $201.4 million, a good increase from $185.3 million in 2024. That's a healthy profit. Their return on average assets, a measure of how efficiently they use their assets to generate profit, was 1.24% in 2025. It is pretty stable compared to the previous year. The efficiency ratio, which shows how much it costs them to generate revenue, was 58.1% in 2025. That means for every dollar of revenue, they spent about 58 cents on expenses. It went up a bit from 2024, suggesting they are spending a little more to earn each dollar. Let's look at the balance sheet. Their total assets grew to $17.3 billion in 2025, up from $15.6 billion in 2024. That is a nearly 11% increase, showing solid growth. Their loans, which are the biggest part of their business, grew to $11.8 billion, up over 5% from the previous year. And how are they funding all this deposits? Total deposits jumped over 11% to $14.6 billion. This is fantastic, showing customers trust them with their money. Stockholders' equity also saw a healthy increase, hitting $2 billion in 2025, up over 11%. This means the owner's stake in the company has grown. Now, for asset quality, their non-performing loans, which are loans that are behind on payments, jumped to 0.70% of total loans in 2025, up from 0.38% in 2024. This is a key area to watch. While still at a manageable level, this increase signals a slight rise in credit risk, and total non-performing assets surged to $164.4 million in 2025, primarily due to $81.5 million in other real estate owned, or OREO, which is property the bank had to take back after foreclosures. Much of this increase is tied to a specific real estate issue in Southern California, involving 7 loans to affiliated entities. Their allowance for credit losses, or ACL, on loans as a percentage of total loans decreased slightly to 1.19%. This suggests they feel confident about their ability to cover potential losses. Their investment securities portfolio grew significantly to $3.7 billion, making up over 21% of their assets. This strategic shift shows they are likely repositioning some of their holdings perhaps to generate more stable income. Now let's talk about risks, because every company has them. EFSE highlights several key risks. They're dealing with the usual suspects like economic downturns, changes in interest rates, and intense competition. But they also point out specific risks related to their SBA lending, being dependent on government programs. And of course, the ever-present threat of regulatory changes. Banking is a heavily regulated industry, and new rules can always impact their operations and profitability. They also flag risks related to climate change, which is becoming a more prominent concern for all companies, impacting their operations and reputation. Cybersecurity is naturally a huge focus. They detail their robust governance structure and risk management strategies, but they candidly admit cyber incidents have happened and may continue to occur. As for their stock, they acknowledge its volatility and the many factors that can influence its price, from earnings to regulatory news and general market conditions. Looking at the company's direction, Enterprise Financial Services Corp seems to be navigating a complex financial environment with a growth strategy that balances organic expansion with strategic acquisitions. Their focus on specialized lending niches and relationship banking appears to be a solid strategy for differentiation. However, the increase in non-performing loans and OREO, largely tied to specific real estate exposures, is certainly a point to monitor closely. While overall asset quality has been strong, diversification and diligent credit management remain paramount. The jump in non-interest income due to those anticipated insurance proceeds is a one-off event, but it highlights the unpredictable nature of some of their income streams. On the expense side, managing the integration costs of acquisitions and deposit growth will be key to maintaining efficiency. Overall, EFSC is demonstrating resilience and growth. Their capital position remains strong, and they are actively managing their market risks. The company's strength lies in its diversified approach and its ability to adapt to market changes. That is the download on Enterprise Financial Services Corp's 2025 performance. What do you think of their financial health and future prospects? Let me know in the comments below. If you found this breakdown helpful, give it a like. And for more corporate financial decoding, hit that subscribe button, and don't forget to join our Discord community for more in-depth discussions. Thanks for watching, and we'll see you in the next video.